This is the 20-year annualized returns by asset class since 1999 all the way up to 2019 by JP Morgan. As we can see, the average US investor is terribly bad at it. We average a return of 2.5% per year for the past 20 years, which basically underperforms any type of asset class that is also illustrated in the chart. This basically means that we could do a lot better just by investing in gold and forgetting about our money, or we could have done so much better just by investing in an index fund which tracks the S&P 500 and forgetting about our money. And I think the main problem is what George Soros mentions in this quote, where if investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. And what he means about boring is that good investing shouldn't involve a lot of buying and a lot of selling. What it should include is a lot of research and a lot of patience. But if the average investor is so bad at it, why do we keep investing? Why do we think we can actually beat the S&P 500? And just to highlight some more evidence about this, there are professionals who are paid millions of dollars to run funds with the sole objective of beating these benchmarks. And according to S&P Intelligence, the majority are not even close to beating the S&P 500. This chart shows the percentage of funds which actually underperform the benchmark, depending on if we look at it from a 1-year perspective or 15-year perspective. If we look at the 1 year, regarding large cap stocks, around 60% of large cap funds actually underperform the S&P 500. But over this same period, around half of all small cap funds actually underperform their benchmark. But if we zoom out and we look at the 15-year performance, around 88% of large cap funds actually underperform the S&P 500, and around 87% of the small cap funds actually underperform the S&P Small Cap 600 index. And these guys are paid millions to run the funds and actually outperform the indices. But why are we so bad at investing? Well, my hypothesis actually is that we don't hold stocks for as long as we should. This graph shows the frequency of the stock market being positive depending on the holding period, from 1926 all the way up to 2021. As you can see, if we've held a stock for around 1 month, there is a 63% chance that this stock in 1 month will be positive. But if we hold onto the stock for 15 years, according to the IMF, there is a 100% probability that our holdings will be positive by that time. And the fact is that the average holding period for stocks is only of 5 months, whereas the average holding period for ETFs is 2 years, meaning that investors actually sell out of stocks way too early and they hold on to ETFs for a longer time frame, which helps actually improve the performance of ETFs and hinder the performance of the average US investor. But now if the evidence is actually stacked against individual stock picking, why don't I just buy ETFs and forget about it? Well, I have some negative points that I don't especially like about ETFs. The first one is of course the fees that the ETF have. Now this graph shows a little experiment that I built in order to track the returns. The lighter shade is the returns from investing in an ETF, and the darker shade are the returns from investing or conducting stock picking. The assumptions here are that the ETF average annual returns will be of 5% with a 1% annual expense ratio, whereas stock picking returns will be a bit lower than the ETF returns, averaging 4.5% per year. Now we can see that the initial investments are actually not too far off. But when you project it into time, as long as 30 years investing, in 2050 you can actually see a very big difference between stock picking returns and ETF returns, because that small difference in performance as a percentage actually compounds over time. But this is not the main point I want to address because it has too many assumptions. If we just take this example, and we assume that you invest $100,000 in 2020 at a 1% expense ratio for an ETF, and you wait over 30 years, the incurred fee you would have at the end of your investment is $62,000, which you paid for the annual expense ratio. This is the most intuitive disadvantage of an ETF. But of course, I have a second one which worries me a lot more. This is the composition of the S&P 500 by the weighting of the different companies. And as you can see, the top 10 companies make up around 37% of the S&P 500. A company such as Microsoft, which currently has a market cap of around $3 trillion, is more heavily weighted in the S&P 500 than a smaller company. meaning that moves in the prices from companies such as Microsoft will impact the S&P 500 by a lot more than any of the other companies in the index. And this, of course, has helped the S&P 500 perform as well as it has. However, it's gotten to the point where I actually don't feel comfortable. In my current investment strategy, I like to invest in companies which appear undervalued and are generating extremely high free cash flows in relation to the price that their stock is actually trading at. When looking at the composition of the S&P 500, Nvidia, for example, to me doesn't fit that test. They're not an attractive valuation. This actually happened a couple of years back with Tesla, where Tesla's valuation rose extremely quickly, and they were quickly positioned as one of the top 10 largest companies in the S&P 500. But where are they now? Those companies are the ones which we could refer to as dead weight companies. These are companies which manage to obtain high weighting into the S&P 500 and then go on to underperform for the rest of the year. But just seeing this composition actually makes me question how much sense does it actually make to invest in the S&P 500? Because the history that they try to sell to us is that you're investing in all of the US. However, that's not true, because 37% of your position is directly linked to 10 companies out of the 500 companies that are actually in the benchmark. Because to me, this is actually not too different from stock picking. It's just that you don't set the weighting of your positions. And actually, I believe we've been sold a fake story of how hard it actually is to outperform the index. If we invest in positions that actually make sense, profitable companies, and we hold these positions for long, there is no reason we shouldn't outperform the index, because the percent of stocks outperforming the S&P 500 from 2007 to 2023 March is not that bad. The yearly average is 48%, meaning that almost half of the stocks inside the S&P 500 actually perform better than the S&P 500. And this goes quite in line with Warren Buffett's quote, where he says that if you have more than 120 or 130 IQ points, you can afford to give the rest away. You don't need extraordinary intelligence to succeed as an investor. And I fully agree with this point. I believe the most important thing in investing is not actually picking stocks. I think it's sticking to a consistent plan, being disciplined, and just being patient. But the thing that I love most about stock picking relates to this graph right here. And it's the frequency distribution of the performance of companies inside the S&P 500. What this tells us is that almost a third of stocks in the S&P 500 in the past 20 years actually had a negative performance. But then if we look to the right side, of 14% of stocks inside the benchmark returned more than 300% in that same time period. But if we listen to Peter Lynch, he says, maybe you're right 5 or 6 times out of 10, but if your winners go up 4 or 10 or 20-fold, it makes up for the ones where you lost 50%, 75%, or even 100%. What I like about this is that investing is sort of forgiving. If you find great stocks and great opportunities, you just need a handful of great investments to become a great investor. So by picking stocks, we have the probability of selecting the ones on the right side, meaning the ones that will return more than 300%, and we have the opportunity to ignore those on the left side, meaning those which actually obtained negative earnings. However, I believe that good investing is actually done when you can sleep well at night. And for some people, this will require them to invest in ETFs, and for some people, this will require them to invest in stocks. And either way is perfectly fine. Because, for example, for ETFs, you first of all have professional management, which helps a lot of people to sleep at night, knowing that their money is well secured. Second one is that there is no need for active management from your part. You can forget about your money, either someone else will be managing it, or it will just be tracking the S&P 500, and you just don't need to worry about it because it just follows the US economy. Number 3 is that it has exceptional past returns, and every single data point indicates that you have a lot more chances of just following the S&P 500 than actually beating the S&P 500. But finally, you have a lot of tax benefits, as there is no need for you to sell out of an ETF. But on the other hand, we have the advantages of stocks, which first of all have a potential for higher returns, they do not have any fees or expense ratios that you actually have to worry about, and you are allowed to avoid dead money stocks, which is harder when investing in an ETF. You also have more control. You choose your positions, you choose your weightings, and you're allowed to buy on dips, meaning that if one of the stocks in your portfolio is actually down and you believe that this is not warranted, you can conduct dollar cost averaging, which is one of the greatest methods of investing. And for me, the last benefit of its stocks is that I love finance, and this is why I actually have this YouTube channel and love speaking with you about this. Let me know what you think in the comments. So thank you, and as always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.